This is good for small financial institutions, good for small business, and good for families across America.
Supporters of us think we're really stupid.
Sweetheart, I don't think you're stupid. I know you're stupid. This video was made possible by my patrons. Just Another ANCAP, Scorch88, and all other patrons at the additional tiers. Thank you so much to all of you. Hello everyone, this is My Two Cents. Senator Bernie Sanders' YouTube channel has recently released a short video arguing against the rolling back of the Dodd-Frank Act, which heavily regulated the banking sector in response to the 2008 financial crisis. Bernie's staff, along with many other liberals, would like you to believe that the 2008 financial crisis was caused by an unregulated free market and that regulations put forward in Dodd-Frank are the only things standing between America and another financial meltdown. However, the exact opposite is true. It was precisely government regulations that caused the 2008 financial crisis, and the Dodd-Frank Act only exacerbated the problem. If you're unfamiliar with the 2008 financial crisis, I've left a link in the description to a video put out by EconClips that explains it in great detail. However, here's a short summary of what happened. Banks all across America gave out mortgage loans at interest rates that were artificially low thanks to the Federal Reserve printing boatloads of new money. Many of these loans were given to people who did not have assets demonstrating that they would be able to pay the loans back. Why did the banks do this? Many different factors, but in particular, the Community Reinvestment Act threatened banks that did not grant a sufficient number of loans to ethnic minorities. Also, two government-sponsored banks, Freddie Mac and Fannie Mae, were given the privilege of purchasing mortgages from other banks with the promise that the U.S. Treasury would cover any loans that went bad. And so the banks were much less careful about who they loaned to than they otherwise would have been. This created a boost in demand for houses, and many more houses were built than otherwise would have been. Numerous different parties believed that they were going to make large profits off of the housing market. However, as was inevitable thanks to what was set in motion by the Fed and subsequently the banks, the costs of doing business in the housing market started to rise. The people who had taken out mortgages started defaulting on their loans. Other people who were counting on the repayment of those loans started to panic, and then the whole system went bust. However, the origin of the bust was first and foremost the Fed artificially lowering interest rates by flooding the market with new money, and government regulations that allowed, and in some cases even required, banks to be much more careless with their lending practices than they otherwise would have been. These things never would have occurred if we actually had a free market in which banks were responsible for looking out for their own interests. With this in mind, let's get into Bernie's video.
This bill is about giving big banks yet another chance to crash our economy.
As I just got done explaining, big banks only crash the economy by making poor decisions that government actions actually encourage them to take. And you think the solution is more regulations? And once banks are deregulated, they'll be able to do business at lower cost, to the benefit of their customers. Further, if government stops bailing out failing banks, they'll be smarter about who they loan to all on their own.
Dodd-Frank has proved to be far too blunt an instrument. For one thing, it's imposed a crushing regulatory burden on small community banks and credit unions.
Very true. The average bank has to cover between $400 to $700 of additional costs for every loan they grant, thanks to the regulations put forward by Dodd-Frank. The large banks that have already been shown to be too big to fail can afford this, but it puts a large strain on smaller financial institutions.
Since when is a bank with between $50 billion and $250 billion in assets tiny and harmless?
Well, JP Morgan has total assets of about $2.5 trillion, so comparatively that is pretty small. However, your question fundamentally misunderstands the nature of banking. No bank is harmless. Every bank could do serious damage to its customers if it makes poor decisions. That's why, under free market conditions, banks know they have to be careful about who they give loans to, not solely out of interest to their customers, but due to their own self-interest. Government oversight is a costly provision that becomes frivolous once banks are forced to look out for their own safety.
Our legislation is going to improve the overall regulatory environment. At the same time, it's going to make improvements for consumers.
Experts at the Congressional Budget Office say that this bill actually increases the likelihood that a systemically important financial institution will fail and that another financial crisis will occur. I spent 5 years researching the causes of the 2008 global financial crisis. Without question, one of the key causes of the crisis was deregulation.
Well, you obviously didn't study it very hard. It was precisely government regulation, such as the Community Reinvestment Act and government promises of backing up loans, that caused the banks to make loans to people that they otherwise never would have under free market conditions. Further, the root cause is the Federal Reserve banking system itself. The government has demonstrated time and time again that it will bail out failing banks, which guarantees that they will continue to make unnecessarily risky decisions. Think about it. Would you be more or less careful with how you spent your money if you knew you had a rich grandfather who had promised to always refill your bank account if you lost it all?
As a Financial Crisis Inquiry Commission report that came out in 2010 concluded, deregulation and reliance on self-regulation by financial institutions has stripped away key safeguards which would have helped us avoid catastrophe.
You really think that banks won't look out for their own interests if their safety net of government bailouts is taken away? Sure, in theory, additional regulations could have stopped the banks from being so reckless, but they were only reckless because of previous regulations. Regulations cost money, and so fixing a problem brought on by regulations with more regulations only ensures that the problem will be fixed in the most costly and inefficient way possible. Why not just get rid of the regulations altogether?
Supporters will tell you that the Bank Lobbyist Act is really just about giving relief to small community banks and credit unions.
We've gotten to the point where arguably small banks are now too small to succeed.
This is true. The large, too big to fail banks can afford to comply with government regulations, but it is a massive burden on smaller banks.
But the truth is, community banks are doing very, very well. According to the FDIC report from the third quarter of 2017, 96% of our nation's community banks are profitable. This is up from about 70% back in 2009.
Stop and think about what that means. Community banks are more profitable than they were in 2009. Does that in and of itself mean that Dodd-Frank regulations are helping community banks? Stop for a second and imagine that we have 100 people suffering from a deadly disease. After 1 month, 90 of those people die, while 10 manage to recover. Would it be accurate to say that the victims of the disease are doing well in virtue of the fact that 10 victims managed to survive? The American Banking Journal reports that at least 1,708 community banks have been forced to close or merge with a larger bank since Dodd-Frank was passed. Further, virtually no new banks have formed since Dodd-Frank. Saying the community banks are doing well in light of Dodd-Frank is like saying that since a small minority of victims of a deadly disease managed to survive, victims of the disease are doing well. If you want more detail on how regulations are hurting community banks, check out this report published by the U.S. Treasury in June of 2017. Link in the description.
This bill lifts sensible limits on two of the largest banking institutions in the country, Bank of New York Mellon and State Street. It also removes the automatic oversight by the Fed on 25 of the top 38 banks. Dodd-Frank sensibly requires lenders to first determine that loan applicants are able to repay before making them home mortgages. Lenders who fail to make this assessment can be liable to borrowers.
And again, the only reason they wouldn't verify the customer's assets in the first place is because they believe the government will bail them out if the loan goes bad. This isn't an unfounded assumption, given American economic history. You really think a bank is going to give out what they know to be a bad loan once their safety net is removed? We don't need more regulations. We need the government to stop interfering in the banking sector.
Lobbyist Act would allow banks with total assets up to $10 billion to actually make unaffordable mortgages with no liability to borrowers, so long as the banks hold these loans on their books. If the bill becomes law, Congress will excuse over 97% of U.S. banks from having to verify applicants' income, assets, and debts for mortgages that they keep on their books. Is there anything good about this bill?
By now, it should be obvious that this isn't a problem for banks that are left to look out for their own well-being. I'm not going to repeat myself.
There's a provision that will require credit reporting agencies like Equifax to let consumers put a freeze on our credit reports without a charge. Yet right now, in states that allow fees, the fees are only about $2 to $10. Is a savings of $10 really worth inviting another financial meltdown? Is it really worth exempting 85% of the mortgage market from fair lending laws? Is it really worth excusing over 97% of U.S. banks from having to verify applicants' income, assets, and debts for mortgages that they keep on their books? The answer is no.
The answer is yes. Have you ever stopped to think about how much money banks spend just to hire employees to read and understand those thousands of pages of government regulations, merely to figure out which ones apply to their bank? Then after that, they have to implement those regulations, which means training their employees and testing for compliance with the regulations that do apply. All the while, the bank must still find the time and resources to meet with individuals and businesses about their financial needs. That $10 fee you're talking about doesn't even scratch the surface of how much more efficient the banking sector will become once it's deregulated. This will, of course, free up time and resources to expand the economy elsewhere, leading to economic growth. The economic illiteracy of Bernie Sanders and his followers is unreal. To summarize the lesson here one more time, banks are businesses looking to make a profit. If they give out bad loans, they will not make a profit, and so they are directly incentivized to not give out bad loans. When the government steps in and bails out failing banks, the banks learn they don't have to be careful with their money. Do you think the answer to fix this problem is more costly regulations or getting rid of government intervention in the banking sector in the first place? And that is my 2 cents. Take it for what it's worth. Thanks everyone for watching. If you liked this video, please hit like and subscribe. You can also hit the bell to ensure you're notified every time I upload a new video. This video was made possible by my patrons. If anyone else would like to donate and help ensure that I have the time and resources to keep putting out content, for just $1 a month on Patreon or Maker Support, you'll have your name listed in the end credits of every video and the link to one of your social media platforms listed in the description. You can also support the channel by purchasing my 2 cents merchandise on Teespring. You can also follow me on Twitter, Minds.com, BitChute, WordPress, Gab, and iTunes. Uploads are every Thursday and Saturday, so stay tuned for more videos.